All right, welcome back. My guest is joining me right now via Zoom. Tajudeen Olayinka is the Chief Executive Officer at Wyoming Capital Partners. Mr. Olayinka, good morning and thank you for joining us today.
Good morning, Nancy. Nice to be with you.
Now, let's get started. The May market gained close to 7%. What really ignited those gains? Because it was as if the market has been on steroids in the past few weeks. What's been happening?
Okay, I think market, somehow establish its capacity, to take advantage of liquidity anytime we have it. What happened was there are several things that happened prior to May 2020. We saw market recovered quickly after the after the initial the initial rally. I mean, we saw profit taking, and then we saw market come back again strongly. So month of May was quite spectacular for the market. It was a month where most investors actually put back their dividends. A situation where listed companies now pay dividend via electronic means. So it means that the investors can easily reinvest their dividends quickly. So we saw so much reinvestment of dividends by especially these institutional investors and maybe some other retail investors, but largely by institutional investors who had access to these dividends that were paid back. That were paid by companies. It also showed that those companies actually did well, and that was why those companies were able to pay dividends. If you look at the industrial sector, telecom sector, all those companies, including banking sector, they pay very good dividends, and so investors were able to reinvest these dividends in some of the listed securities, and that was what prompted some of the rally. Also because stock market has also demonstrated its capacity to adjust to inflation. We also saw that demonstrated by investors, appetite for equity. I think the strong performance of the companies in that first quarter, and of course, in the year-end results that gave rise to very, very reasonable level of dividends by companies, actually brought the market back to the level that we have it today. So it's more of liquidity coming to the market through different sources, mostly from reinvestment of dividends.
Okay, Mr. Olayinka, the way the market is right now, at a position of about 24% year-to-date return, is the equity market currently beating inflation? Of course, nominally, you would say it is beating inflation because with a year-to-date return of 24%, inflation is standing at around 16.82%, if I'm not mistaken, for the month of April. That, of course, has beaten inflation, hands down. But the question I'm really going for is, which sectors really have beaten inflation? Because the aggregate market has beaten inflation, but what sectors really drove that positive change that is warranting the market beating inflation? I hope you understand my question.
Yes, I do. I'm following you. I do.
Yes.
I think if you look at it very clearly, consumer goods, actually took the lead there. Okay. We saw so much interest in consumer goods, the breweries, the food industry, the agri sector, especially this Okomo oil and Pesco. We saw investors showing interest in companies, in stocks of companies that have capacity to adjust to inflation. And so we saw more of this in consumer goods and industrial goods as well. We also saw that in telecom. Telecom also did well, and the fact is that stock market has that capacity, and that capacity is often demonstrated by the listed companies, not just listed companies, even firms that are not listed. Anytime we are in an inflationary environment, companies tend to adjust in the short run. This short-run adjustment, especially, being able to adjust to variability of cost and cost pressures, make them close to the market in that short run. These companies can easily adapt to inflation issue in the market, especially the consumer goods sector. We saw some companies, being able to adjust their prices, even though the prices did not go up. They adjusted their prices to the extent that the volume was what now dictated the pace. So some of them reduced the volume while maintaining the old prices, something that we call shrinkflation. So those sectors that were able to do that were actually the ones that investors took advantage of. So market that, I mean, the listed companies have that capacity, and they have demonstrated that. We saw that in their Q1. We also saw that in the full year results. When companies can adjust to short-run average cost in the market, those companies are usually the toast of investors in times of inflation, and that was what we saw in the last 5 months, especially in the month of April and May. Most companies that were able to adjust and adapt their system to inflationary environment in the economy were able to also give good returns, and that's what we are seeing. Most investors are being attracted to those sectors, largely consumer goods and those stocks in the agricultural sector. We saw most of that there. Don't forget also, in the short run, firms must adjust. They must adjust to availability of cost, and in the long run, they must be able to recover our costs. So we saw most of these, attracting investors, to that space.
If we take a look at the interest rate hike by the CBN's MPC just a few days ago, can you speak to me about the impact it's had on the equities market, the hike in MPR to 13%?
Okay. When CBN took that decision to hike MPR, market actually reacted. There was that initial reaction that would normally come from the market. Market reacted strongly, and we saw so much sell down on that very day. Before the announcement was made, normal profit taking was going on, and the investors were taking their profit, entertaining themselves. But the moment the announcement was made at about 12:30 and 1 o'clock, we saw a different market entirely. Market went down massively. In fact, there was a massive sell down on that day. And so what that means that the market reacted strongly to that hike in MPR, moving from 11.5% to 13%. That's about 150 basis points. That was quite significant, and markets reacted accordingly. We also saw that reaction the following day. I think it was the third day we now begin to see slight adjustment, minor recovery, especially from heavyweight like Airtel that lifted the market subsequently. So market reacted initially, and that is usually the initial reaction. Anytime interest rate goes up, especially if it is dictated by central bank, market wants to know how yields in the fixed income will also react. And the moment markets realize that even though CBN has hiked the interest rate, MPR, monetary policy rate, we saw a situation where the birds were still the birds still choose to stay in the cage, even when the cage had been left open. So the birds were refusing to fly to the sky, and so market reacted by repricing itself upward quickly. And so that was what we saw, after the announcement of MPR. Usually anytime we have this kind of situation, what will dictate how equity market will react is what happens in the fixed income market. The fixed income market doesn't seem to be reacting so strongly, and not because they don't want to react. So the investors, they don't want to react so strongly. It's because the latitude is actually not there. They still have that limited supply, and the fact that we have that limited supply in the market means that limited supply of those fixed income securities will mean that the liquidity surface will remain. Anytime we have high in some developed economies like like US and European economies, you see that you see tremendous adjustment in both fixed income and equity market. But we do not. I do not think that CBN has the capacity to sort of create good supply of securities by doing excessive mop-up, because all this mop-up comes at a cost. They don't have the capacity to do excessive mop-up to be able to cause interest rate to actually go up. So what we have seen so far is that we saw, short-term adjustment in the equity market. We have also seen short-term, upward, upward movement in yields, even though we are now seeing that the yields are actually moderating down again. Not because investors don't like to have a higher yield, but because of the fact that the liquidity overhang is still there, creating, subduing the capacity of that market to react to yields.
Okay. Mr. Olayinka, I would like you to give me some kind of investment guidance for beginners, for people that are watching right now, that is seeing what you're saying, or that are hearing what you're saying rather, and will want to take advantage of the 24% rise of the Nigerian stock market from January till date. What kind of guidance would you give to such people that want to profit from the Nigeria's stock market? Because it's looking like if it continues this way, that means the market may close in the positive territory by the end of the year. But of course, there's a caveat, anything can happen, but it's still looking very bright right now. So how do people profit from the Nigeria stock market now? What should they do?
Okay, especially for I will start with with the beginners. The beginners will need to approach a stockbroker. Discuss with a stockbroker his interest or her interest in the market. What he needs to get from the market, and by doing so, the stockbroker will take such prospective investor through what I'll call investor's profile. Profile that investor in the way that you will know whether this investor is actually ready to take a big risk, or is he the one that want to take does not even like any risk that can take away the value of his money or the value of his investment. So all these things will make will make a broker to actually provide a lead in that area. And what will a broker do? Most of these broking firms now have asset management companies. The asset management companies have been licensed by SEC to manage portfolio for investors. So a beginner will need to hand over his investment or his intention in terms of money and what he hope to achieve. Hand over that to an asset management company who will now, looking at the profile, the risk tolerance level, the objective of that investment, to put that investment put that money in appropriate securities. It could be fixed income, it could be equity, it could be real estate investment trust, it could just be passive investment like exchange traded funds. There are several avenues that a beginner can benefit from the market. Can take to in order to benefit from the market. But the most important thing is for a beginner not to go to the market barefooted. Don't go without wearing slippers or shoes, because you might mash your leg on a sharp object. But it's important to go through a professional, a stockbroker, or an asset management advisor who can take you through this process. That's for the beginner. But for those who have those insurance investors who already understand the market, I do not need to advise them, because they know where to go. They know what to do. And for those of them who are just coming newly, who are also insurance investors who want to benefit, it's also important that you can also use asset management company. Go to a stockbroker, let them profile you and send you to an asset management company that can be of help to you. In that way, you can invest. You can begin to invest in the market. Now, the beauty of that market now is that we have an investment class that I would call a derivative market, that makes it possible for you to even hedge your risk in the event that your fear comes into reality in future. That derivative products will help you to actually hedge those risks, and that is recommended for those institutional investors. And I think most of them are already taking advantage of that. We have been seeing that in the market anyway. So investors who cannot take the risk, who also want to hedge their risk, can take advantage of that. Clearly, it's important that an investor or a beginner go through an asset management company or go through a stockbroker.
Okay, so I know you've been hinting it in your earlier remarks, but which asset classes are attractive now? For those that are watching and want to take advantage of that, which asset classes are attractive now? That's the A part of the question. The B part of the question will be around the cyclical stocks and the non-cyclicals in the market. Are both of those stocks offering advantages now, or should investors stay away a bit from cyclical stocks, having in mind that cyclical stocks, you know, tend to trend with where the economy goes? If the economy is up, of course, they will trade well. If the economy is down, they would not trade that well. Not cyclical, whether the economy is up or down, they are trading. We saw what happened during COVID. There were some things that we did not need. We did not go for them. So those things that we really needed, we went for them during the lockdown. So which asset classes are attractive, and should investors go for cyclical and non-cyclical stocks? Mr. Olayinka, I don't know if my second question is interwoven with the first,
I got you right.
But you got me, yeah. Go ahead.
Okay. Now, I will start by saying that all asset classes are actually attractive, depending on investors' objective and risk tolerance level. I mentioned earlier that fixed income does not give, much fantastic return, but it guarantees safety of your investment, especially if you invest in government securities like federal government bond or treasury bills. This asset class is capable of giving you regular return, especially it maintains a regular cash flow. Even if you are not selling in the market, you are sure that if you want to hold to maturity, you get back your investment and you get the return that has been assigned to that investment. So for that, yes, it's a good investment class, but it doesn't. Most times, fixed income security does not beat inflation. They find it difficult to beat inflation, not because investors don't have interest in pushing it up, or because the capacity of a central bank to mop up excess liquidity in the system is always not there, and you can't fault CBN in that area, because what is happening that even when CBN is trying to play its own role, the fiscal authority is also not there. And don't forget also that because of the fact that CBN is also playing some kind of fiscal role by way of anchor borrower scheme, lending to different intervention funds in different sectors. Those things are actually affecting liquidity in the system. So in a way, we will expect that fixed income will give you good return, but yields are always not at the level where you may want to have it. Then the other one is I will go to equity. Equity class is just another good investment class. You can have 100%, and you can also have 0%, or you can even have negative. When I say negative, it means you can actually have your act for investment impaired by losses. Where you enter a stock at X naira and it's now trading at X minus Y naira. So all these things are possible. But if an investor or a client has been properly profiled, one will know which asset class to go to. But in the area of equity, there are some stocks that are doing very well there. Like I mentioned earlier, if your risk appetite does not warrant you going to stocks that can have you locked down, just the same way we had lockdown during the 2020 pandemic lockdown. You can also have your investment lockdown, whereby you can't even take any action. And that is where this issue of cyclical stock comes in. Cyclical stocks are those stocks that move with inflation. That move with the prospect in the economy. When the economy is doing well, they also do well. In fact, some of them do much better than the economy. And when the economy when the economy begins to nosedive, they also nosedive with the economy. And so somebody who is not somebody who is risk averse may be advised not to go into cyclical stocks. Cyclical stocks are usually those stocks in the industrial sectors. Stocks that when people are badly pressed, they may not necessarily go. They may not necessarily show interest in purchasing products of those companies. Okay. And not that those companies won't sell, but they won't sell as much as what they used to do that gave profit in the past. So you can have your money locked down in those securities, and they are mostly they are mostly in industrial sectors.
Okay.
And I will take. Okay, I will take. I will also look at stock like cement company.
Okay.
Yes, though government is intervening in that sector by way of patronizing them, but anytime there is problem, building sector will not really be. I mean, industrial goods like construction.
Okay, Mr. Olayinka, if you can hear me, thank you very much, Mr.
Do well when market is going down.
Okay.
And again,
thank you very much, Mr. Olayinka. I think we've got to go. If you can hear me, yes, we've got to go now. We'll continue this conversation sometime. Thank you very much for joining us today. I've been speaking with Tajudeen Olayinka, the Chief Executive Officer at Wyoming Capital and Partners. Mr. Olayinka, thank you very much. I can see you. Thank you. Thank you. We'll do this again sometime. We've got to go. All right, that's the much you can take. Okay. Be the best you can be and be the change that you want to see. I am Nancy Naji. I'll see you all again tomorrow. Bye for now.